is you gave us the authority to send every month your check of or your the money transfer to the insurance account, right? So this is the complete bank statement items here. Now, bank reconciliation we were talking about over there. So normally the bank statement balance, it is not equal to, it's not tallying our cash book, because cash book we are maintaining, accounting. We are having accounting entries and we are posting into our ledgers. So ledger of cash, which we call the cash book, over their balance, it does not tally with the bank statement. So does it mean that we are having, as an accountant, we are having a fraud? Not necessarily. If after bank reconciliation statement there is a huge difference, then we can say that there can be a chances of fraud. So cash account in the complete ledger. So 2 records of business cash. One is maintained by bank through bank statement, and one is maintained by cash inside the company. So difference occurred because of time lag. For example, bank statement came on 31st of December. On 31st of December, you issued check of 200,000. When you issued a check of 200,000 from your cash account that you are maintaining inside company, you deduct cash. For example, paid cash to supplier. So here, accounts payable to cash, and you write it down through check. So in your account, your cash is further reduced by 200,000. But the person who received this 200,000 check, he did not go to the bank on 31st of December. So on 31st of December, your account is showing 200,000 balance and bank account is showing 400,000 balance. So this is not equal, right? Does it mean that there is a chance of fraud? No, because the one we have issued 200,000 check, he did not go to the bank on the same day, right? If we deduct this 200,000 from here, we will see that our cash account is equal to the bank statement account. It means we reconcile our discrepancy or difference between company cash account and company bank account. Understand, everyone? Sipadwe?
How long can the, sorry, I have a question.
Yeah.
How long can the time lag be? Like, what's the maximum time?
A check normally is giving you 6 months. So you can see the time limit here. If company give you the check, normally the check time period is between 6 months or maybe more. It depends on bank to bank, right? Some bank can honor that, some bank can say that no, you need to have a fresh new check issuance, right? So it depends. So plus there are other stuff as well, like in this bank statement, we authorized our bank to submit insurance on our behalf or collect amount from the customers. For example, customers are not coming to us to inform us that we have paid our balance. They just go to the bank and submit. So we don't know. Our accounts are still there that he didn't pay us, but he deposited all the things to the bank account. So we were waiting to see that whether this person has deposited the amount to the bank or not. So that is also a discrepancy or the difference between cash book and the bank account difference. The service charges, it is in the bank statement, but it is not in the cash book because we don't know this month how much charges by the bank. Plus, we don't know about the non-sufficient funds check or bounce check. We issued the check, customer go over there, but the check is bounced, right? According to our books, we already deducted that one, but in bank statement there is no cash, so they rejected that one, right? So what he will do, he will come back to you and say that issue me a new check. So we need to add back that NSF as well, right? So let's talk about in detail what are the possible reasons for this discrepancies. So on bank side, either why the bank and book side are not equal, either there's the deposits in transit. For example, you issued a paid order or you issued a check. It takes 2 to 3 days to clear that one. Bank receives the check, but it takes 2 or 3 days processing time to transfer money to your account or from your account to other account. We call this deposit. Deposit means to your account, customer deposit in your account, and it takes time to collect. In your book, for example, you received a check of $200,000, you write it down on your books. This customer has paid his debt, and you submit to the bank. The bank needs 2 to 3 days to clear that check. So the difference can occur between these dates. We call the deposit in transit. Outstanding checks. You write it down checks, but customer did not present to the bank. This can be a difference. And then the banking errors. Banks over there are also run by humans, and humans can make some mistakes, right? We cannot expect any mistake from the computers, but we can expect mistakes from humans, right? So what are the differences of from the book side, bank collections? For example, we gave the facility to the customer that you don't need to come to us, just deposit the balance to the bank. That's it. So we are not informed whether this customer submitted his amount or not. And then electronically funds transfer. What if you did electronically funds transfer? You did not record it here. There is no check issued or there is no hardcore evidence. You just log on to company account and transfer the money. That's it. Right? Service charges of the banks. You don't know, right? Until you receive. So you will write it down in book side. Interest revenue. You have outstanding balance with the bank. Like in China, if you have the account over there, so after every 3 months or 6 months, you receive 1 yuan or 2 yuan or 6 yuan or 50 yuan as interest income, right? So you don't know until you receive the bank statement, then you need to record it, right? So this is not in your book. Non-sufficient funds, checks, NSF checks or bounce checks, right? You paid to the customers, but that are bounced. It means you need to take them back and cancel those payments and then reissue that check. You will also accompany on the book side. Plus cost of printing checks or the bank charges, similarly like a bank charges, are also going to be recorded here. Plus you can also make errors, right? Let's talk about this. So we are going to do bank reconciliation statement. So I'm going to give you 5 minutes to read all this illustration here. And after that, I'm going to read it and we try to solve it together. Okay? So let's read it. I'm going to give you 5 minutes to read that. Here we go. So on December 31st, bank balance of Mid-Atlantic Manufacturing was 5,900. Company's cash account balance was 3,340. So there is clearly difference between that one. And the additional information is like that deposit in transit is equal to 1,600. Deposit that we need to receive that one. right? Bank made an error. The bank deducted 100 for a check written by another company. So you need to add back to the bank balance as well. Outstanding checks totals 1340, which means you write it down the checks, but your suppliers, they didn't present those checks to your bank. EFTs, electronically fund transfer receipts of your dividend revenue earned on the investment, 900. That is just electronically coming to your account. So your bank balance has, but your book balance, it don't have. So cash account, your cash company's cash account, it don't have this one. So you need to add back this one. Bank collected of your account receivable, 2100. So bank has this information, you don't have this. So you will look at that one. Interest revenue earned, your book, you don't, you your account or your book balance does not accommodate this $30. Plus you make an error. You write it down the check as 510, instead the amount was 150, right? So how much you need to reverse to the entry? 360, right? Bank services, bank has those charges in the bank summary, but you don't have that one. Then you will also write it down in your cash account or in your cash book. NSF check from a customer. Customer paid us a bogus check. When we receive from the customer, we decrease the customer. But since our check is bounced, we will increase our customer for the same amount. Right? So EFT payments of an insurance expense, 400. Banks paid our payments on our behalf. So bank has this information, we don't have that. So let's reconcile it. So what is the procedure here? There are two methods to do that. One is the statement method, one is account method. In account, you make like this. This is like bank side. This is cash side, and at the end it tallied. So this is a statement type in which you write it down like this, like balance sheet statement type. So you write it down first the balances. So balances are 5,900, and what was missing in cash? Deposit, in transit, and corrections, and outstanding checks. So total balances are 6260, right?